Welcome to a deep dive into some really fascinating source material. We're talking about a topic that touches every single one of us, whether we want it to or not. Money.
That's right. And we've got insights here from excerpts that argue something pretty fundamental. Doing well with money. It often has less to do with how smart you are and a whole lot more to do with how you behave.
Exactly. It's a real shift in perspective,
Yeah.
away from just spreadsheets and complex formulas.
It leans heavily into psychology, emotion, and maybe most importantly, our own personal histories with money.
So our mission here is to unpack these ideas. We want to pull out the most important nuggets from these sources and see what lessons they might hold for you.
Let's jump right in with that core idea. Behavior is key.
Yeah, and the source kicks off with a couple of really striking stories that really drive this home.
Right. It contrasts this high-flying executive, someone earning a ton, but incredibly careless, like, throwing cash around, replacing perfectly good lamps with $1,000 ones just 'cause. And despite all that income, he ends up broke.
Wow. So the resources were there, but the behavior.
Exactly. It undid him. Now, compare that to Ronald Read, a name maybe more people know now.
Janitor philanthropist, right?
That's the one. Listed as American philanthropist, investor, janitor, and gas station attendant. First in his family to finish high school, hitched rides there.
Lived incredibly frugally, I remember reading.
Super frugally, invested patiently for decades. And when he passed away, this unassuming janitor had built an $8 million fortune, became a huge philanthropist.
That difference is it's stark, isn't it? It's not saying intelligence is irrelevant.
Not at all.
But a genius can lose control, make disastrous financial decisions. And someone, ordinary, with no fancy finance degree, they can build serious wealth by mastering a few key behavioral skills.
It's the doing, not just the knowing. That's the core message.
And that really sets the stage for looking at money through this psychological lens, doesn't it?
Yeah. Perfectly. It explains why money is so universally impactful, like health, everyone deals with it, but why we disagree about it so much.
Yeah, that's a great point. Think about healthcare. Science has largely pushed out old, maybe even harmful ideas.
Right. We have a broadly shared understanding of how the body works, how to treat things, and that's led to huge gains in health globally.
But the money world, it still feels, confusing sometimes. Lots of conflicting advice, different camps yelling at each other about what's right.
And the source suggests it's because we often treat money problems like physics problems expecting hard rules, laws.
Instead of psychology problems.
Exactly. Which are messy, emotional, nuanced. Money becomes this incredible magnifying glass for just understanding human behavior, period.
Yeah, so here's where it gets really personal for you, the listener. Your own experiences with money. They're like the bedrock, the foundation of how you view everything financially. And they vary wildly.
Oh, absolutely. Think about growing up in poverty versus wealth. Your whole framework for risk, for saving, for spending, it's just fundamentally different.
Or living through high inflation, like in the 70s or early 80s.
Yeah, you'd see cash and bonds very differently than someone who only experienced, say, the low inflation of the last couple of decades.
The source uses examples like a stockbroker wiped out in the Great Depression versus a tech worker in the dot-com boom.
Or someone in Australia who, until recently, hadn't seen a recession in 30 years compared to an American who's lived through, 2008, 2020.
Right. Very different lived realities.
And here's the kicker from the source. Your personal experience. It might be a tiny sliver of world history, like 0.0000000000001%. But it makes up something like 80% of how you think the world of money actually works.
Wow. 80% from that tiny slice. Okay, that explains a lot.
It explains exactly why two equally smart people can look at the same data, the same stock, the same forecast, and come to totally opposite conclusions about what to do next.
It's not just the facts, it's the filter they're seeing them through.
Precisely. There's that study mentioned by Melmandier and Nagel. They found investment risk tolerance isn't just about smarts or education. It depends heavily on personal history, basically, the dumb luck of when and where you were born.
That's kind of wild. So my lived experience dictates my risk appetite more than my financial literacy, potentially.
To a large degree, yes. The emotional weight of those experiences. Think of Bill Gross, the bond king. Huge success, right? But tied undeniably to decades of falling interest rates. That was his generation's experience.
But his father's generation
lived through high inflation. They might have seen bonds as wealth destroyers, not builders. Same asset class, totally different perception based on lived history.
And we can see this in the charts shown in the source material, too. stock performance for someone born in 1950 versus 1970 during their teens and 20s.
Yeah, for the 1950 cohort, the index barely budged, stayed near 1. Very little growth in those formative years.
Probably leads to a more cautious view of stocks, maybe.
You'd think so. But the 1970 cohort, that index went from 1 to over 9. Huge growth while they were coming of age financially. Their baseline perception of the market's potential is just different.
Same thing with inflation. Born in 1960, prices more than tripled in your teens and 20s. You felt that sting.
You really did. Gas lines, everything costing more, that sticks with you. But born in 1990, inflation's been mostly a non-issue your whole adult life. It might not even factor into your thinking much.
It's just not part of that 80% of personal experience. So these different histories create these deep-seated views on risk and reward that you can't just, logic away with a spreadsheet.
And that helps us understand things that seem irrational on the surface, like the lottery ticket example.
Right. Americans spend a fortune, especially lower-income folks. It seems counterintuitive.
It does, purely financially. Blowing cash on a 1,000,000-to-1 shot when you might not have emergency savings looks bad on paper.
But the source pushes us to see the psychology.
Exactly. It acknowledges, yeah, it's probably a bad financial move. But for someone feeling trapped, where saving a bit more or earning a bit more feels impossible, buying that ticket, it's not just about the tiny chance of winning.
What is it then?
It's buying a tangible dream. It's maybe the only moment they feel they have a shot, however small, at the kind of life they see others having. They're paying for the feeling, the hope, the dream itself.
So that phrase the source uses. What you're doing seems crazy, but I kind of understand why you're doing it.
That applies to so many financial choices, doesn't it? Decisions made not on spreadsheets, but in the real world. With ego, pride, history, marketing, all swirling around.
It really underscores how human finance is.
Absolutely.
Yeah.
Which brings us to luck and risk. Things that feel outside our control, but the sources argue play this huge, often ignored role.
Yeah, it's hard for us to really grapple with luck, isn't it? We like to think outcomes are purely down to skill or effort.
We do, but the examples are compelling. Bill Gates and Ken Evans, both brilliant, driven, but Gates had that lucky early access to a school computer. Huge difference.
Or Cornelius Vanderbilt building a fortune after breaking laws that could have easily landed him in jail instead.
Right. Where's the line between bold risk-taking and just getting away with it? Or Benjamin Graham, the father of value investing. His biggest win came from Geico, an investment that, by his own discipline rules, was way too concentrated.
So is it genius analysis or just a massive lucky break?
And he basically admitted he wasn't entirely sure. It shows how thin that line between bold and reckless really is. You often only know for sure in hindsight after accounting for luck and risk.
It's easy to label something reckless after it fails and bold after it works.
Exactly. Which is why that Warren Buffett quote is so good. Success is a lousy teacher. It seduces smart people into thinking they can't lose.
So paradoxically, when things are going really well, that's when you need to be most aware that luck's probably playing a part.
And that means risk is present too. Things can turn. Nothing is ever quite as good or quite as bad as it seems in the moment.
Which leads right into this idea of never enough. That story about Kurt Vonnegut and Joseph Heller.
Oh, it's brilliant. At a billionaire's party, Vonnegut says, our host made more money yesterday than you made from Catch-22 in its entire history.
And Heller's reply is just perfect. Yes, but I have something he will never have. Enough.
That concept enough is so simple, yet so profound, and apparently so hard to achieve. The sources tell the story of Rajat Gupta, rose from poverty, CEO of McKinsey, worth $100 million.
I mean, for almost anyone listening, that's more than enough. Way more.
But he risked all of it for more. Insider trading, prison, he didn't have enough.
Buffett had that quote about long-term capital management too, right?
Yeah.
The hedge fund with all the Nobel laureates that blew up.
Yeah. He said, to make money they didn't have and didn't need, they risked what they did have and did need, and that's foolish.
That feels like maybe the single most important rule to take away. Don't risk what you have and need for something you don't have and don't need.
It really is fundamental. For most of us, the goal isn't hitting billionaire status. It's getting to a point where income and savings comfortably cover needs and, a good chunk of wants.
And the hardest financial skill, the source says, is getting that goalpost to stop moving.
Yeah. Resisting that urge for just one more dollar, even when you already have plenty for a secure, happy life.
Because some things are just never worth the risk, no matter the potential gain.
Your reputation, Your freedom, your independence, family, friends, love, happiness. These are the real valuables.
And knowing when you have enough, when to stop taking risks that could destroy those things, is maybe the best way to protect them.
Speaking of things that take time to build, let's talk about time itself and compounding.
Ah, yes, confounding compounding. It's so powerful, but so hard for our brains to really grasp intuitively. The Ice Age analogy in the source is great.
It really is. Miles of ice. Not from one huge event, but from tiny layers of snow surviving one extra summer, then another, compounding over millennia.
Tiny changes adding up to enormous results over time. Not brute force, but persistence.
And that's exactly how money works with compounding. Small amounts can become extraordinary if given enough time. Which brings us back to Warren Buffett.
Right. You said his story is less about being the greatest investor, return-wise.
And more about being a good investor for an incredibly long time, since he was basically a kid.
And that calculation showing the difference time makes is just staggering.
It really is. If he started at 30, retired at 60, with his actual amazing 22% annual return, his net worth would be under $12 million today, not $84.5 billion.
That's 99.9% less wealth, just from having 30 fewer years for the money to grow.
His skill is undeniable, but his fortune is really about skill plus time, massive amounts of time. Compare him to Jim Simons at Renaissance. Simons' returns are way higher, like 66% annually since '88.
Yeah,
phenomenal.
But he's worth much less than Buffett.
Because he only started compounding like that at age 50. Less than half the time Buffett had. If Simons had his returns over Buffett's time frame, the number is just astronomical, meaningless. 63 quintillion or something.
Yeah, okay, point made. Time is the magic ingredient. Our linear brains just don't get that exponential curve. 8 plus 8 is easy. 8 times 8 gets wild fast.
Look at data storage. 1950 to 1990, we gained 296 megabytes since 1990. 100 million megabytes. Even Bill Gates famously underestimated it early on. You just never get used to how fast exponential growth can accelerate.
But, and this is the crucial but, compounding only works its magic if you can stick around, if you can stay invested for those long periods.
Which means survival. That's the key word. Getting money is one thing. Keeping it, staying in the game, that's everything.
Sequoia Capital, the VC firm, their whole philosophy is built around that, right? Assuming tomorrow won't be like yesterday.
Only the paranoid survive, as their former head said. They're always thinking about what could go wrong. Contrast that with Jesse Livermore and Abraham Germansky in the 1929 crash.
Livermore made a fortune shorting the market. Germansky lost everything, betting on it going up.
Right. Livermore looked like the winner. But just 4 years later, overconfident, making huge leveraged bets, he lost it all too, and eventually took his own life.
So both were brilliant at getting rich.
But terrible at staying rich. They lacked that survival instinct, that room for error.
And you mentioned Buffett again. What he didn't do was get wiped out.
Exactly. Staying solvent, even if it means holding some cash that's not earning much sometimes, is incredibly valuable. It stops you from being a forced seller at the absolute worst time during a panic or crash.
So good returns sustained over a long, long time beat great returns that get interrupted by ruin.
Absolutely. Which leads us right into thinking about planning, risk, and the inevitability of failure.
Okay, so planning is important, obviously. But the key is planning on your plan, not going according to plan.
That's the core idea. Reality just never follows the script perfectly. Think about the last couple of decades, 9/11, the housing crisis, the financial meltdown, COVID. Huge unforeseen events change everything.
So a good plan has to embrace that uncertainty.
Yes. It needs room for error, a buffer. You need your plan to still work or at least keep you afloat, even if market returns are lower than you hoped or you lose your job or whatever life throws at you. Fragility comes when your plan requires everything to go exactly right.
It still feels weird, though. How can something be failing or chaotic in the short term, but lead to success long term?
It is counterintuitive. The source uses examples like brain development in toddlers, pruning connections looks like loss but leads to smarter adults. Or Disney's early cartoons often losing money, but those failures were necessary steps towards building the empire. Short-term pain, sometimes essential for long-term gain.
And this ties into tail events, those rare outliers that have huge impacts.
Exactly. Venture capital is the classic example. Most startups fail. A few do okay. But 1 or 2 massive hits the tails drive virtually all the returns for the entire fund.
And the source shows this isn't just a VC thing. It happens in the broad stock market, too.
Yeah, that JP Morgan data on the Russell 3000 is eye-opening. From 1980 to 2014, 40% of all the stocks in that index lost 70% or more and never recovered. Basically catastrophic failures.
40%. And these are public companies, supposedly successful ones.
Right, and almost all the overall market gain came from just 7% of the companies that were monster winners, the extreme outperformers.
And looking at the industry breakdown of those catastrophic losses, it's high everywhere, even in supposedly safe sectors like utilities, where 13% failed massively.
It just shows failure is common, even for established players. So what does this mean for you? It means most of your day-to-day financial moves probably don't matter as much as what you do or don't do. During those few critical periods, maybe 1% of the time when markets are going crazy and fear takes over.
Like that example of the 3 investors saving $1 a month since 1900. Sue just stays invested. Jim tries to time recessions. Tom times them even worse.
And Sue, just by staying cool and sticking with it through the downturns, which was only about 22% of the time, ends up with way more money, like 75% more than market timers.
Just from enduring those periods of failure and volatility.
Exactly. It's normal for things to fail. You have to expect it. Bezos talks about Amazon needing big failures to find big wins. The tails rescue you.
Soros said it's not about being right or wrong, but how much you make when right and lose when wrong.
Right. You can be wrong often, even half the time, and still make a fortune if your wins are big enough and your losses are contained.
Which comes back again to room for error. It's not just being conservative, it's essential for endurance.
It lets you survive the inevitable downturns and uncertainty, so you're still around to benefit from those rare, massive wins when they finally arrive. Like a card counter needing enough chips to write out the bad hands.
In leverage, debt is the enemy here because it removes that buffer.
It absolutely demolishes your room for error. It turns normal market swings into potentially ruinous events. Rational optimism is great, but leverage can make you ignore the real possibility of ruin. And getting wiped out means you miss all future opportunities.
The source mentioned a barbell strategy.
Yeah, take calculated risks with some money, but be incredibly conservative, maybe holding cash with another portion. It seems inconsistent, but the goal is total survival, ensuring the risky bets have time to potentially pay off.
Survival first, then success. Which leads to a really interesting point about how we should aim to make decisions, being reasonable versus purely rational.
This is such a key insight. You're not a spreadsheet, right? You're human, emotional, sometimes irrational. So aiming for cold, hard rationality might not even be the best goal.
The example of treating syphilis with malaria fevers was memorable.
If slightly gruesome, but it makes the point. Inducing a high fever did sometimes help, won a Nobel Prize even. It was miserable for the patient.
Right. People naturally fight fevers because they feel awful. A purely rational analysis might say let the fever run, it might help, but that's not reasonable or tolerable. A doctor aims to cure within the bounds of what the patient can reasonably endure.
Apply that to investing. Harry Markowitz, Nobel laureate, founder of modern portfolio theory, the definition of rational investing. How did he invest his own money?
He split it 50-50 stocks and bonds, right? Not based on some complex formula.
No. He did it because he wanted to minimize his future regret. He wanted to feel okay no matter what the market did. That's hard to justify rationally on paper, but it's perfectly reasonable for a human being making decisions with real emotions and consequences.
Because investing isn't just numbers. It involves spouses, coworkers, keeping up with the Joneses.
Exactly. There's a huge social component. Think about the purely rational case for a young person using lots of leverage. The math might suggest higher long-term returns if they can stomach the volatility.
But nobody can actually do that.
Right.
Watch their life savings evaporate and just rationally stick to the plan. It's absurd in reality.
Utterly unreasonable. They'd panic, sell at the bottom, and probably swear off investing forever. Being reasonable means choosing a strategy you can actually stick with, even if it's not mathematically optimal.
And sticking with it is key, because the odds of success in markets, historically, improve dramatically over longer time horizons. Endurance puts the odds in your favor.
Which is why do what you love isn't just fluffy advice. If you love your career or even enjoy your investment approach, you're more likely to endure the tough times, which is critical for long-term success.
What were some other examples of reasonable beating rational? Home bias.
Yeah, investing mostly in your own country isn't rationally optimal diversification. But if that familiarity makes you comfortable enough to actually invest and stay invested, that's reasonable.
Or day trading small amounts.
Not rational for most. Odds are against you. But if it scratches an itch, keeps you engaged, and stops you from messing with your serious long-term money. may be reasonable for that person in moderation. Like Josh Brown said, it's my money, I like stocks.
Even making forecasts. Terrible track record, not rational from a prediction standpoint.
But totally reasonable because we're wired to want to know what's next. Acting on them is the dangerous part, but the desire itself is understandable.
Even Jack Bogle, investing in his son's higher fee fund. Not rational by his own low-cost gospel.
But perfectly reasonable as a father supporting his son. At some point, the source suggests you have to choose. Do you want to be happy or do you want to be right according to some cold, rational calculus?
Let's talk history. It's vital for context, but the source warns strongly against treating it as a map for the future.
Right, the historians as prophets fallacy. Finance isn't physics. The rules, the players, the technology they evolve, relying too heavily on very old data can be misleading because the underlying structure has changed.
So recent history is often more relevant.
Generally, yes, because it reflects more of the current structural realities. That phrase, "it's different this time," gets mocked, but Michael Batnick's point is good. The real danger might be thinking it's never different. Sometimes things genuinely change.
What are the big dangers of leaning too hard on history?
One is overweighting past outlier events that won't repeat exactly. Think of the huge, unique events of the 20th century, the Depression, World Wars, Cold War, 9/11. The future will have its own unpredictable outliers, but they won't be repeats. Kahneman's point. The lesson from surprises isn't the specific surprise, it's that the world is surprising.
Okay, expect the unexpected. What's the second danger?
Not accounting for structural changes, things we take for granted now. 401ks, Roth IRAs, widespread venture capital, they're relatively new. Phil Knight couldn't get VC for Nike early on.
So historical data on savings, startups, funding models might not apply directly today.
Exactly. Even Benjamin Graham's value formulas might not work the same way because of increased competition, global markets, tech-changing industries. The landscape is different.
Okay, let's pivot slightly to pessimism. Why does it seem to get more attention and sound smarter?
It's interesting, isn't it? John Stuart Mill pointed this out ages ago. Pessimism just sounds more intellectual, more profound somehow. Optimism can sound naive.
Remember Igor Panarin predicting the U.S. breakup in 2008? Front page news. Wildly optimistic forecasts rarely get that traction.
But true optimism isn't just naive cheerleading. It's more like Hans Rosling's possibilism, acknowledging setbacks but believing the odds favor progress over the long term.
So why is pessimism more persuasive day to day?
Progress is slow, incremental. It's like watching grass grow, hard to notice. But setbacks, they happen fast. A market crash, a lost job, a crisis. They're sudden, scary, and easy to build a compelling story around. Loss of confidence spreads quickly.
Like 2008. The physical capacity was still there, but the narrative broke down.
Exactly. Confidence evaporated, and that tanked the economy. And when people feel vulnerable or desperate for solutions, they become willing to believe things.
Like medieval medical cures, or bad investment advice, or even Ponzi schemes like Madoff's.
Yeah. The need for an answer, any answer, can be overwhelming. Which circles back to why room for error and financial independence are so valuable. They reduce that feeling of desperation, that need to grasp at straws.
We all have these simplified mental models of how things work based on our limited view.
Like a baby figuring out a room. We project that onto complex systems like economies or markets. It's like that alien circling Earth, confident they understand, but totally missing the internal human stories driving everything.
A good reminder of our own limitations.
Definitely. Okay, let's talk about wealth itself and the irony that true wealth is often what you don't see.
The valet in the Ferrari story captures that perfectly. You see the fancy car, assume the owner's cool or rich.
But you're not really admiring the driver, are you? You're admiring the car, you're picturing yourself in it. Or maybe just using its price tag as a new benchmark for your own desires.
So people buy things to signal status, but others often just bypass admiring the person and use the stuff as fuel for their own wants.
Bill Mann's quote nails it. No faster way to feel rich than spend lots of money. But the way to be rich is to spend money you have and not spend money you don't have.
And the source takes it a step further. The only way to be wealthy is to not spend the money. That's the definition of wealth-saved assets.
Being rich, high income, maybe high spending, is different from being wealthy, assets saved and invested. Getting those confused is a root cause of bad decisions trying to look rich instead of actually getting wealthy.
And getting wealthy comes down to, well, saving. Simple, but maybe the most important habit.
Yeah, the sources really hammer this home. Past a basic income, you're either saving, think you can't save, or think you don't need to. This is crucial for those last two groups. Building wealth is less about income or returns and much more about your savings rate.
Like the oil crisis analogy, efficiency mattered more than finding new supply. Controlling your spending, your financial efficiency, is more in your control than hitting home runs with income or investments.
And you don't even need a specific goal to save, saving just for saving's sake. It's a hedge against surprises. Life will surprise you.
And it buys you control over your time. That's maybe the biggest payoff, the investment banking story.
Yeah, great pay, felt important, but zero control over time made it miserable. Doing something you theoretically love, but on someone else's punishing schedule, feels like doing something you hate.
Or David Sivers finding independence not from selling his company, but from having just $12K saved earlier, enough to quit his job and pursue music full-time.
That initial saving bought him freedom. That's powerful.
Which connects to another big idea. You will change. Long-term planning is hard because you making the plan isn't the same you living it out decades later.
We're terrible at predicting our future selves. We imagine the goal, the career peak, the retirement number, but not the stresses, the compromises, the changes in desire along the way.
Like the lawyer example.
Yeah.
Chasing money, hating hours, wanting flexibility, lower pay kids, maybe unprepared for retirement because the original goal evaporated. That winding path is normal.
Psychologists call it the end of history illusion. We always think we've changed a lot up to now, but won't change much in the future. But studies show everyone from 18 to 68 underestimates future change.
So how do you plan long-term when you know you'll change?
Endurance again. And balance. Avoiding extremes at any given point makes it more likely you'll stick with some kind of plan and avoid major regrets.
Don't live like a pauper just to maximize savings, but also don't work yourself into misery chasing the highest possible income.
Exactly. The benefits of those extremes fade, but the regrets, lost time, poor health, broken relationships, insufficient savings, they stick around. Aim for moderate savings, moderate free time, moderate commute, time with family. Balance increases the odds you endure.
And don't let sunk costs trap you. Be willing to abandon goals made by your past self if they don't fit the current you.
Mercilessly abandon them, the source says. Okay, let's wrap up with the price of success and a quick look at how consumer expectations got shaped.
Right, nothing's free. Success in investing has a price volatility, fear, doubt, regret. Easy to ignore until you're feeling it.
And trying to dodge that price often means paying more later, like GE cooking the books to smooth earnings. Shareholders avoided the volatility then, paid way more when it unraveled.
Bubbles are tough too because everyone argues about the cause afterward.
Like the dot-com bubble. Why pay crazy prices for Yahoo in '99? For many, it wasn't long-term irrationality, it was short-term speculation. Day traders don't care about 10-year value, just today's price movement. They're playing a different game.
And the danger is getting sucked into their game, making decisions based on their short-term focus, especially with spending.
Trying to impress people with stuff often fails because, as we said, they're not admiring you. They're benchmarking their own desires. Humility, kindness, empathy that earns more respect than horsepower.
Okay, so how do we get to this modern consumer mindset? The source traces it back.
To post-WWII. Fear of another depression led policymakers to deliberately boost consumption through low rates and easy credit in the 50s. Credit cards took off, household debt exploded.
Faster growth in debt then than even in the 2000s bubble, you said.
Yeah. Combine cheap credit, pent-up demand, and new manufacturing capacities, switching from war to consumer goods, boom. Suburbs, appliances, cars for everyone.
And from the 50s to the 80s, growth was broadly shared. The gap between rich and poor narrowed. Lifestyles became more similar.
People compared themselves to neighbors who were actually living similar lives. But after the 80s, growth returned but became much more skewed. Top income soared, others stagnated.
But expectations didn't adjust. People still felt they should keep up.
Largely, yes. And debt was now seen as normal, even necessary to maintain that expected lifestyle. So Peter, whose income didn't rise much, took on huge debt to live like Joe, whose income had skyrocketed.
Bigger houses, more bathrooms than people, bigger car loans.
And household debt to income doubled from the early 70s to 2007. It fundamentally reshaped behavior, regardless of the why or whether it was right.
And those expectations might linger even if inequality changes, because culture moves slower than economics.
It's a complex inheritance we're still dealing with.
Okay, we have covered a massive amount of ground here. Let's try to distill some key takeaways from this deep dive.
All right, first, respect luck and risk. Focus on what you can control: your behavior, your savings rate. Find good role models based on repeatable success, not just lucky outliers.
Second, Less ego, more wealth. Saving is that gap between your ego wanting to spend and your income. Real wealth is often invisible, built by delaying gratification.
Third, just save. Seriously, you don't always need a specific reason. It's your best hedge against surprises, and it buys you independence and control over your time. Invaluable.
Fourth, understand and be willing to pay the price of investing success. That price is volatility, fear, doubt, regret. See them as fees, not fines. Trying to avoid them costs more.
Fifth, worship room for error. That buffer is crucial for survival. It lets compounding work its magic over the long haul. It's not just conservative, it's essential.
Sixth, avoid financial extremes. You'll change, your goals will change. Extreme plans often lead to regret. Balance promotes endurance.
Seventh, independence control over your time should be a top-tier financial goal, maybe the top goal.
And finally, aim for reasonable, not always coldly rational. Good decisions are ones you can stick with, ones that let you sleep at night. Sometimes you have to choose happy over technically right.
Yeah, your relationship with money is this unique blend of your personal history, your generation's experience, and the bigger economic shifts that shape the world around you.
It really is a fascinating mix of psychology, history, and sheer chance.
Couldn't agree more.
So, here's a final thought for you to take away. Building on all this personal history, luck, risk, compounding change. Knowing all this, how might you look differently at the next financial decision you make? Not just the numbers, but the story you're telling yourself about it, the context, the behavioral forces at play. Something to think about.